Have you even wondered how close $100,000 actually puts you to a million? Money can feel like a slow drip. Flow of contributions plus returns changes speed. But what turns slow into fast is the moment growth starts making growth. It is the point where your gains begin to pull most of the weight. And that shift reshapes how the next decades play out. So how to reach that point without undoing your life? Stay tuned as we break the math, show real numbers, and give clear steps you can use this week. Have you paused and measured what $100,000 looks like in a long-term investing plan? Most people treat saving as a simple measuring tape. A dollar saved equals a dollar closer. That view misses what happens when money is placed into an investment account that earns returns, and those returns earn returns. Start with a rule you can test. Pick a weekly contribution and a realistic long-run return, then let the math do the rest. For one useful example, imagine you commit $200 per week into a broadly diversified investment account and leave that habit in place without trying to time markets. That $200 per week is about $866 per month, or roughly $10,400 per year. Using a conservative long-term annual return of 7%, compounded weekly, this plan reaches $100,000 in about 7.36 years. Over that 7.36-year span, you will have deposited roughly $76,516. The remaining roughly $23,625 in the account comes from investment growth rather than your direct deposits. Those numbers mean the first six-figure mark is mostly your own money plus an early dose of growth, but that early growth sets the base that later compounds much faster. The numbers above rest on a realistic historical picture of real returns. Long-term studies that remove inflation show stock market real returns in the mid-single digits over multi-decade stretches, while nominal returns over long spans typically land in the low double digits. If you want to review the long-run evidence, there are public analyses that summarize century-scale real returns and nominal S&P returns across many decades. Why does $100,000 feel so different once you have it? Because the math of compounding favors the larger base. With the $200 per week example, it takes around 7.4 years to get to $100,000 and another roughly 4.8 years to double that to $200,000. That means you hit $200,000 in about 12.2 years from the start. The time to reach each successive milestone shortens because the sum that's earning returns is larger. Each dollar of growth begins to produce its own future growth. Continue the same $200 weekly habit, and the model hits roughly $1 million in about 29.24 years. By then, you will have deposited about $304,064 and seen roughly $695,442 come from investment growth. So around 70% of the final total will be growth, not direct deposits. Those are not hand-wavy claims. They follow the standard future value of an annuity formulas and basic arithmetic you can check with any reliable calculator. The policy implication is straightforward. Steady deposits plus time create momentum, and momentum is the main engine that turns modest savings into large balances. Real life often forces the question, where do I find the extra cash for a $200 weekly habit? Common household categories provide multiple levers. Transportation is a major recurring cost for many families. Industry reports from auto data sources show average new car monthly payments that exceed $700 for many buyers, while used car payments often sit in the $500 range. Choosing a less expensive vehicle, increasing down payment, or taking a longer search window can free substantial monthly cash that flows directly into investments. Food spending is another area where modest adjustments yield steady investment capital. Recent national data show per capita food spending in the high thousands per year, with spending on dining out growing faster than grocery spending in recent years. For many households, modest changes, cooking more meals at home, planning grocery trips, and trimming a few restaurant visits each month can free several $100s a month to redirect to investing. Those changes are small compared with the power of compound growth. To make the effect clearer, compare a few alternative scenarios. Scenario A is the $200 per week plan at 7%. Scenario B halves the cash flow to $100 per week, but assumes a slightly higher average return of 8% to reflect a heavier equity tilt. Scenario C doubles the cash flow to $400 per week, while using a conservative 6% return to reflect a more mixed allocation. In Scenario A, you reach $100,000 in about 7.36 years and $1 million in about 29.24 years. In Scenario B, the lower cash flow means it takes longer to reach the first 6 figures, on the order of 11 years or so, even with a higher assumed return. In Scenario C, you cross $100,000 much faster, and the path to $1 million shortens dramatically because contributions are larger from day one. A clear corollary follows. If you start late and want to hit the same targets in the same time frame, the required weekly deposit rises quickly. For example, compressing the $1 million target into about 19.24 years at the same 7% assumption requires roughly $475 per week. That is a big jump versus $200 per week, which shows why starting earlier makes the math easier. If you cannot start with large deposits, begin smaller and increase contributions gradually when possible. Employer retirement matches and tax-advantaged accounts are among the fastest ways to accelerate progress. The typical employer match, according to large plan provider surveys, is in the neighborhood of 4.6% of pay for plans that offer matches. Common matching formulas include 50 cents on the dollar up to a set portion of pay. Claiming any available match is conceptually equivalent to an immediate return on your contributions, and skipping the match is literally leaving money on the table. For many workers, maximizing the match is one of the highest return moves available. Fees and expenses are the other factor many people underweight. Using the $200 per week example over roughly 29.24 years, lowering the annual fee you pay on funds from 1.0% to 0.1% under the same gross market return assumptions can increase your terminal balance by tens of thousands or even well over $100,000 in many scenarios. Large fund providers and industry analysts have shown how lower expense ratios directly increase net returns over time. Choosing low-fee vehicles for the bulk of your portfolio is a low-risk, high-return move. Market downturns are inevitable, and that fact often scares people into doing the costliest thing, selling near the bottom or parking cash out of fear. Historically, disciplined investors who continue to buy through declines buy more shares at lower prices, which increases their gains during recoveries. The technical name for steady contributions is dollar-cost averaging, and while it's not a magic bullet, it reduces the risk of buying a large position at an unlucky high. The practical outcome is that downturns, when navigated with discipline, often help long-term investors rather than harm them. Psychology is central in a way the math alone does not capture. The person who proves they can save and invest enough to hit 6 figures has demonstrated 2 skills that matter more than clever stock selection: discipline and delay of gratification. Those skills make higher balances easier to reach later because habits are stable and because behavioral bias is the enemy of compound growth. Once an account tiptoes into 6 figures, seeing that balance grow month to month changes behavior. People become more likely to prioritize saving windfalls, to automate raises into savings, and to treat investing as the default rather than an afterthought. Optionality also grows with balance. A $100,000 liquid investment position is not retirement wealth on its own, but it expands choices. It makes it possible to take an entrepreneurial test without catastrophic risk, to take a lower salary role with equity upside, to put a down payment on an income-producing property, or to fund education that raises future income. Those options have monetary value that is hard to capture in a single account balance number, yet they influence lifetime outcomes meaningfully. Taxes and account type matter too. Tax-advantaged accounts keep more money invested for longer by delaying taxes on growth. In many cases, a traditional retirement account reduces taxable income now and defers tax until withdrawal. Roth accounts accept tax now and allow tax-free withdrawals later. Both are tools to manage the drag taxes can impose on long-term compound growth. Using the right account for the right goal, retirement, house down payment, tuition, keeps more money working for you. Concrete numbers help for perspective. With the $200 weekly plan at 7%, contributions by year 7.36 are about $76,516 and investment growth about $23,625. By the time you get near $200,000, the share of your balance that comes from growth increases dramatically. By the $1 million point, the growth share dominates. Those snapshots are useful because they make the point that if you can make the first sustained effort, the rest is mostly a momentum story. Delaying the start by a decade matters in practical ways most people underestimate. If you begin the $200 per week habit at age 25 and remain consistent, you hit the $1 million target around your mid-50s. If you begin the same habit at 35, you still reach $1 million, but roughly a decade later. If hitting a target by a particular age matters, the required weekly savings to compress the timeline can increase materially, as the earlier example with a compressed 19-year target shows. Small boosts and smart choices move timelines more than many expect. Putting a $5,000 annual bonus into the same account every year, adding modest increases to the weekly deposit as your pay grows, capturing employer match, and lowering fees all multiply through compounding. Even one step, automating a transfer, enrolling in a plan, or switching from an expensive actively managed fund to a low-cost broad index vehicle, creates cumulative effects that compound across years. Risk management matters too. Keep 3 to 6 months of living expenses in liquid accounts so you do not have to sell investments during a drawdown. Diversify across broad asset classes so you're not dependent on a single sector or theme. Pay attention to fees and provider quality, and use tax-advantaged vehicles when appropriate. All of those moves reduce the chance that a single shock derails a decades-long plan. If you are careful about numbers, some additional lessons appear. Employer matches are, in effect, extra free contributions that accelerate milestones. Low fees preserve a larger share of your returns, and small increases in your weekly contribution produce outsized effects over decades. Public sources on employer match prevalence and on industry fee trends show these levers are typical and available across many workplace plans. For many households, finding the extra $100 to $300 a week that changes their long-term outcome is an exercise in reallocation rather than deprivation. It looks like redirecting a portion of recurring transportation cost, pausing recurring entertainment subscriptions you rarely use, treating tax refunds or one-time bonuses as savings fuel, or converting some dining out occasions into home dinners. The behavioral part is simple to describe, and, for many families, not as painful to implement as fear implies. The central numeric insight remains. $100,000 is more important than the proportional label of 1/10 of a million. In many realistic saving and return scenarios, the leap from $100,000 to $1 million can take fewer years than the initial run to 6 figures because the growth engine is larger. That dynamic is the practical math behind why steady saving earlier in life is such a leverage point for future freedom. This is not a forecast that your account will behave identically each year. Markets move up and down. The claim is the structural property of compound returns combined with steady deposits. If you want a personalized projection, I can run exact scenarios tailored to your age, target date, weekly or monthly contribution, and return assumptions, and produce a year-by-year table that shows balance, cumulative contributions, and growth for each year. That table will show exactly when investment growth becomes the majority of your balance and how different choices, raising contributions, capturing an employer match, or switching to lower-fee funds, change the timeline. Start with one small action this week. Set up a modest automatic transfer timed with payday and pick a low-fee broad index vehicle for the initial deposit. Over time, raise that transfer as income grows. If you want, I will run the exact numbers for your timeline and contribution level, show a year-by-year balance breakdown, and compare simple changes like lowering fees, adding employer match, or increasing contributions by fixed amounts over time. That table will show exactly when compound growth takes over for your situation and how much of the final balance comes from returns versus your deposits. Tell me your age, weekly contribution, and whether to use a conservative or aggressive return to calculate today. If you found this video helpful, make sure to hit that like button and drop a comment with your thoughts or questions. Don't forget to subscribe and turn on notifications so you never miss tips that can grow your wealth faster. Thanks for watching.